Hey everyone, welcome to this explainer. Today we're diving deep into the mechanics of contra funds. More specifically, we're going to put the brand new Motilal Oswal Contra Fund under the microscope. If you've ever found yourself drowning in financial jargon or those dense scheme documents, don't worry, you are in exactly the right place. We're going to break all of this down visually and keep it super straightforward. Let's get right into it.
Think about this for a second. Have you ever bought something just because everyone else was completely ignoring it? Maybe a piece of real estate in a really quiet neighborhood, or some quirky vintage item that absolutely nobody else saw the value in. Well, that instinct, that urge to go against the crowd, is actually the foundational principle of a very specific and highly fascinating financial market strategy.
So here is our roadmap for today. We'll quickly cover what is a contra fund, how contra investing actually works, the specifics of the Motilal Oswal Contra Fund, where the money goes, the risk and reward, and finally, we'll wrap up with taxation and investment basics.
All right, Section 1. What exactly is a contra fund?
So, the crucial concept to grasp here is that word contrarian. A contra fund is an open-ended equity scheme that is literally designed to intentionally go against the grain of the broader market. Instead of just chasing the hottest tech stocks or jumping on whatever trend everyone is raving about on the news, it actively hunts for what the crowd is leaving behind. It's a totally unconventional and frankly deeply analytical way to approach equity investing. Moving on to Section 2. Let's look at how contra investing actually works in practice.
Okay, picture it like this. On one side, you've got current market sentiment. We're talking about stocks that are underperforming, undervalued, and maybe facing some short-term negative press or a temporary sector slump. The crowd is basically screaming sell or stay away. But on the flip side, fund managers are looking at the long-term potential. They are on the hunt for fundamentally sound companies whose true intrinsic value, what the business is actually worth beneath the surface, is just totally mispriced by the market right now. They're buying the underlying fundamentals, not the current market mood.
Now, there is a catch here, and it's a pretty big one. Because you're essentially waiting for the broader market to wake up and realize the true value of these overlooked stocks, you absolutely need patience. This strategy requires a long-term investment horizon. It's just not suited for short-term investors who are looking for a quick flip. Plus, it places a massive reliance on the fund manager's skill. I mean, let's be real. Most of us struggle to time the market on our own, right? So it's up to the pros to dig into the macro and micro data to spot these hidden gems way before the crowd catches on.
Let's jump into Section 3 and look at the Motilal Oswal Contra Fund. So let's take all that theory and see how it's applied in the real world. We'll use the new Motilal Oswal Contra Fund, as outlined in their recent new fund offer, or NFO, as our primary example today. They're bringing this exact contrarian strategy straight to investors right now.
To actually find these mispriced stocks, the fund uses what they call their QGLP philosophy. This stands for investing in quality businesses with reasonable growth potential and longevity, which basically means a sustainable competitive advantage over time, all at a fair price. It's all about finding that sweet spot where a fundamentally strong, long-lasting business is temporarily trading at a discount. By strictly insisting on quality and longevity, this philosophy kind of acts like a safety net. It makes sure the fund isn't just scooping up cheap, failing companies, but rather solid businesses that are just going through a temporary rough patch.
And hey, remember what we literally just talked about, how heavily this whole strategy relies on the fund manager's expertise? Well, it's definitely worth noting the combined experience steering this specific ship. The equity portion is managed by Ankit Agarwal, who brings over 20 years of investment experience across global markets. He's co-managed by Varun Sharma, who brings over 15 years to the table. Plus, they're backed by dedicated managers specifically handling the debt and overseas components of the fund. That is a lot of seasoned eyes on the data.
All right, Section 4. Let's talk asset allocation, or simply where the money actually goes. What's really fascinating about this fund's setup is their heavy commitment to the contrarian strategy. While basic mutual fund rules in India require contra funds to invest at least 65% in equity, this specific Motilal Oswal fund aims for a massive 80 to 100% allocation primarily in equity and equity-related instruments of contrarian companies. That is a huge slice of the pie. The remaining 0 to 35% can then be flexibly deployed into debt, money market instruments, REITs, or even some foreign securities, totally depending on what the market is doing. Now, because they're picking such a diverse range of contrarian stocks across all sorts of different sectors and market caps, they need a really broad yardstick to measure their success. So the fund's performance is officially benchmarked against the Nifty 500 Total Return Index. And honestly, that makes perfect sense. The Nifty 500 represents the broad market, and that's exactly what they're trying to outperform with these highly selective, contrarian bets.
Moving right along to Section 5, the risk and reward of betting against the crowd.
If we look at the official riskometer gauges, both the scheme itself and its Nifty 500 benchmark sit firmly in the red, very high-risk zone. Make no mistake, this isn't some guaranteed smooth ride. You're exposing yourself to daily price fluctuations, macroeconomic shifts, and realistically, periods where the fund might actually underperform the broader market if really strong popular trends are dominating.
To really sum up this risk profile, the source material hits the nail on the head. It states, quote, "Owing to the fact that contra funds invest in stocks that are yet to reach their full potential, they possess a higher risk-reward ratio." Listen, betting against current market sentiment is just inherently volatile. You have to accept that higher volatility, meaning the possibility that a stock takes way longer to recover or maybe doesn't recover at all, in exchange for the potential of significantly higher rewards when those overlooked assets finally bounce back to their true value. It's high risk, high potential reward.
Finally, Section 6. Let's go over the taxation and investment basics.
Since this is classified as an equity mutual fund, it's taxed exactly like one. If you hold your units for less than 12 months, any profit you make is considered short-term capital gains, and that's taxed at 15%. But if you hold for more than 12 months, which, let's be honest, aligns perfectly with the intended long-term nature of this whole strategy, your profits fall under long-term capital gains. That means you get taxed at a lower rate of just 10% on profits that exceed 1 lakh rupees in a single financial year.
Getting started here is actually super accessible. You can participate in the Motilal Oswal Contra Fund with a minimum investment of just 500 rupees, and that goes for whether you're dropping in a lump sum or setting up a SIP. After that initial amount, you can invest in multiples of literally just 1 rupee. But definitely pay close attention to the exit load. To heavily discourage short-term trading, if you redeem your units within the first 365 days, you're going to get hit with a 1% exit load penalty. Wait until after a year, though, and that exit load completely drops to nil.
As we wrap up this explainer, I want to leave you with a final thought to chew on. Reflect on your own portfolio, your personal timeline, and your own temperament as an investor. Ask yourself, do you truly have the stomach to wait out the crowd? Do you have the risk appetite, and more importantly, the patience required for contrarian strategy to actually pay off? Going against the grain definitely isn't for everyone, but for those willing to look where others absolutely aren't, the potential is undeniably intriguing. Thanks for joining me on this explainer. Keep learning, keep questioning the crowd, and I'll see you in the next one.